All right, let's get into it. We're tackling a huge question today. When a country signs a big trade deal, what is it that actually gets foreign investment to come pouring in? You'll see pretty quickly that the answer, well, it's way more interesting than you think.
You know, most people think this is a pretty simple formula. A country signs a free trade agreement, they slash the taxes on imported stuff, the tariffs, and bam, the investment money just starts rolling in. It sounds like a surefire plan, doesn't it?
But is that the real story? Not even close. So what's the secret ingredient? What really moves the needle and brings in that flood of new investment? Let's get into it.
Okay, so let's start by looking past the obvious stuff. If it's not all about just cutting taxes at the border, what else is going on under the hood?
Take a look at this number. This is the best-case scenario for Kenya's GDP growth from a potential trade deal with the US. Now look, any growth is good growth, but that's not exactly an economic tidal wave, is it? It's a pretty clear sign that just slashing tariffs isn't the whole picture.
Right, because the biggest roadblocks are often the invisible ones. We're talking about non-tariff barriers. This is all the behind-the-scenes stuff. Crazy complex regulations, different product safety standards, or just endless paperwork to get a license. For a business, it's like trying to navigate a maze made of red tape. And honestly, these hidden walls can be way, way higher than any tax.
So, tackling those invisible walls, well, that comes down to the actual architecture of the trade deal. The real power isn't on the front page, it's buried deep in the fine print.
You can think of trade agreements as coming in two main flavors. You've got your shallow deals, which pretty much just do the basics. They cut the tariffs. But then you have the deep deals, and these go way beyond that. They get into things like aligning regulations between countries, protecting investors from governments that might suddenly change the rules, and even setting clear guidelines for state-owned companies. It's all about creating a stable, predictable playground where businesses actually feel safe enough to invest for the long haul.
And this isn't just a theory. The data really backs this up. A big study looking at investment in China found a super clear pattern. The deeper the trade deal, the more foreign investment a country pulls in. It turns out investors want way more than just a tax break. They're looking for stability and transparency. They want a reliable system, and that's exactly what these deep provisions deliver.
But here's the catch, and it's a big one. All those fancy, deep provisions, they're pretty much useless if they aren't legally binding. I mean, think about it. Businesses are all about certainty. Imagine you're building a massive factory that makes just one tiny part for a smartphone. You have to know, without a doubt, that the rules for shipping that part across the border aren't just going to change overnight. That's why having a legally solid agreement is absolutely critical.
But look, having a great rulebook is only half the battle, right? You've also got to have good referees on the field to actually enforce those rules.
And that's exactly right. A study of West African nations found this direct link between good governance and whether or not a trade deal actually works. We're talking about the fundamentals: a strong rule of law, sensible regulations, and low corruption. Without those things, a country just can't follow through on its promises.
And you can really see the pathway here. It's like a chain reaction. It starts with good governance. That makes it easier for a country to actually implement these deep trade commitments. Then, that reduces all the uncertainty and extra costs for businesses. And what does that lead to? A really attractive investment climate. It all flows from having strong institutions in the first place. So really, building that market confidence isn't about one single thing. It's a whole ecosystem. You need a strong system to handle disputes when they pop up. You need to align regulations so companies aren't lost in a maze of bureaucracy. And you've got to make sure there's a level playing field. At the end of the day, it's about building this entire ecosystem of trust that makes an investor say, okay, I feel good putting my money here.
So that's the theory, right? Deep deals plus good governance should equal a ton of investment. But what happens when that clean theory crashes into the messy reality of the global economy?
Well, what's fascinating is that the impact of a trade deal is never a simple story with one winner. Just look at Indonesia. One of their big trade deals was fantastic for rubber exports, but it actually ended up hurting their palm oil industry. Why? Probably because it opened them up to tougher competition. It just goes to show you, one size definitely does not fit all. The devil is always, always in the details of each specific sector.
And of course, you can't forget the human element. These deals aren't just cooked up in a lab with economic models. They are hammered out in the real world, shaped by politics and national debates. A perfect example is the UK's trade deal with Australia after Brexit. It was hugely influenced by the political vision of a new global Britain.
And sometimes those big ideas can end up prioritizing certain goals over what might be the most economically efficient choice, which totally changes the final deal.
Okay, so we've peeled back all these different layers. What's the real bottom line here? What does it all boil down to?
So, what's the big takeaway here? I think it's that attracting foreign investment is kind of like baking a really complicated cake. It's not about one ingredient. You can't just cut taxes and call it a day. You need all the pieces. The deep provisions in the deal, high-quality governance, and a legal system that businesses can actually rely on. And you always have to remember that what's good for one part of the economy might be a total mess for another.
And that leaves us with one final thought to chew on. We've seen how much the nitty-gritty details of a deal matter and how critical good institutions are. But maybe, just maybe, underneath all of that, the single most important factor is just trust. I mean, think about it. When it comes to getting someone to invest their money for decades to come, what good are the best rules in the world if nobody actually trusts that they'll be followed?